Hey, I'm Richard Matthews. I run a wealth management firm in downtown Greenville and Fountain Inn, South Carolina. I've shot tons of videos on market trends, planning strategies, and financial education, and honestly, at this point, I've just talked too much. I'm bored of the sales pitches I hear in financial media, so now I'm interested in what other local financial experts are thinking about in the upstate South Carolina economy and markets on the No Nonsense Investor.
All right, welcome back to the No Nonsense Investor. We're here at Floor Field with the Greenville Drive, and Chris Beard is joining us today from Professional Planning and Wealth. And Chris, tell us who you are.
So I'm a managing partner of Professional Planning and Wealth. We're part of a corporate registered investment advisor that's based out of Atlanta, but obviously we're here in the upstate.
So what brought you into the RIA world, moving away from the BD?
So while we still have broker-dealer licenses internally, really the registered investment advisor side, so the RIA side has been around since 1940, as you know, and it's really the fiduciary side of the world, right? Meaning it's our obligation to put our clients' interests first in all that we do. And so transparency is extremely important. Client first is extremely important. So obviously that's attractive both to us serving the public as well as to our client.
Certainly. I can understand that. I mean, my background in 1933 and 34 Securities Exchange Act was BD. And I think maybe it took me a long time to figure it out, just because, you know, you're building up a client base, you're building relationships, you're proving that you're going to do what you say you're going to do. And ultimately it leads you to doing what's in the best interest of clients. And therefore, how do I, as a fiduciary, stand out and say, this is my way of life? This is my value add to clients. And I think it going forward, pretty much for everybody in this industry, we're all starting to see that this is the right route.
You know, if you say to your client, hey, trust me, I mean, shouldn't they be able to? And obviously the fiduciary registered investment advisor route accomplishes that for us because it's part of the regulation.
Right, definitely. And I'm happy to see, I guess, that the BDs now have different schedules and the way that they have to disclose their relationships, their selling agreements, their commissions, and so forth. But it does seem like that side of the industry is starting to track the RIAs and realizing that it's starting to hit home with investors. And that's part of the reason why No Nonsense Investor came up, is we want to start uplifting the rest of the RIA industry, because this is the right route for investors. It's the right route for advisors, and it's just a good mix. So I'm super thrilled to have you here.
Absolutely.
One of the biggest parts that I get to talk about, you know, growth of the upstate and employers laying off and hiring and all that stuff. But we're going to talk about portfolio construction, which is thrilling to me and obviously to clients as well. Maybe not really, but let's talk a little bit strategic, tactical. What's your take on how you build a portfolio?
So just to kind of give some background as it relates to strategic. So strategic, there was actually a gentleman, Harry Markowitz, who won a Nobel Peace Prize for building strategic portfolios. And the whole idea was being fully invested all the time and you know, allocating in different areas, whether it's U.S. stocks, non-U.S., big companies, small companies, bonds, non-U.S. bonds, etc. So strategic just means being fully invested all the time, but in different areas, right? Occasionally rebalancing, etc. Tactical, however, means something different. Tactical implies that, you know what, there are actually times when things are pretty good out there in the world. And sometimes things, you know what, are a little more challenged. It could be that the market's a little bit more expensive. It could be that, you know, there's, I don't know, a war in Ukraine. It could be a supply chain issue. It could be commodities, you know, going up quite quickly. It could be fiscal stimulus caused so much demand economically that there's a bunch of inflation all of a sudden, right? Or all those things could be happening at the same time.
Definitely.
Which is what's been happening in 2022, as you know. So being more tactical just means, you know what, sometimes their offense is on the field and that's good, which is going to look almost identical to strategic at that point. But there are also times when defense needs to be on the field, and that's where tactical comes in more.
That's awesome. That's a great way of putting it. The Harry Markowitz was that was modern portfolio theory, not so modern because 1946, if I'm not mistaken, is when he did that.
That's right. It also implies that markets are always efficient. And I think that's pretty debatable as well.
I agree. The timing and the efficiency is always up to the subjectivism. I think Markowitz kind of came from the Austrian economic theory, which I'm a big proponent. All my clients know I'm like diehard Austrian, but yeah, as he came over, Chicago School of Economics kind of took over and made modern portfolio theory a much bigger practice, which is the underpinning, I think, of how we both manage money on the strategic side of things, where we aim at a target rate of return, we minimize the standard deviation, keep the fees as low as possible, and then we take advantage of the opportunities. And also, like you said, I love it, play defense sometimes. So in today's age, with the inflation, with the interest rate hikes, good money market rates and good bond rates we're starting to see, what are some of those tactical moves that you see as maybe playing out in the next 6 months to a year?
Well, I mean, we're probably closer to the end of the cycle than the beginning because of the fact that the difference between the Fed funds rate and the 10-year government bond is really pretty tight. I mean, at the beginning of the year, there was a spread of 3%, somewhere in that neck of the woods between the Fed funds rate and the 10-year government bond. But now you look today, and when I say that, I mean, towards springtime. But as you look at it now, it's pretty tight. I mean, right now, when I left the office, the 10-year was like 3.85, and the effective rate of Fed funds is now, I think, 3.83.
Yeah.
So, I mean, you're getting really close together. The question is, how much further does the Fed go?
Right.
Historically, when the Fed funds rate has run into the 10-year government bond rate, there hadn't been a whole lot more that they've been able to do in terms of raising rates. But the reality is that this is kind of a different time period, so it's really tough to know. One thing for certain, though, I mean, we haven't seen stocks trade against a 4% 10-year government bond in, over a decade.
Yeah.
So now you're at a point where the question is, where should the market be priced? And earnings have been slowing the past couple quarters. So with earnings slower, the big question becomes, okay, what do I want to pay for not a whole lot of earnings growth in the market right now, especially if I could go out and buy a 4% 10-year or heck, a 4% 3-month T-bill for that matter. Now how long it stays there is another topic.
Sure.
But at the end of the day, we're just in an environment where there's more choice. And the question is, what do investors do with their stock money?
Right. And I like how you brought up the market efficiency conundrum and how efficient a market is. But now we do have that weighing of interest rates and getting paid for parking our money in bonds or shorter term, higher yielding, pretty much guaranteed assets. And so the opportunity cost versus the net yield, when we're looking at inflationarily, especially is that's, I think when we were talking, that's a really good decision point as to when do we lock in some duration, some longer term bonds, because I've been in this for 17, almost 18 years now. And this was the beginning of my career where we had normal interest rates. And I know everybody says they're high, but a 7% mortgage, a 4% CD, like this is the way it's supposed to work. Right. And it does give us that decision point of, is it worth the risk? And I think that's probably, since we've had these low interest rates, one of the biggest problems is people are making the decision of what is worth risk. And for advisors like ourselves with clients that need yield, we've had to push it into higher volatility positions and asset classes tactically to try to pace the lower inflation of 3%. And now that we're in the sevens, it's a whole different ballgame. But is it worth it is a great question that we finally get to ask again.
Right.
Yep. So tactically, it's looking like it's the question of market efficiency. And I think when we look at short-term yields or 10-year yields, trying to chase the Fed, or is the Fed chasing the yields? We're not exactly sure, but CPI finally came down a little bit in this last report. Core PCE will be a big read in about a week and a half, I believe. So as we're watching that, I think the Fed is completely sold out on stopping the inflation. how we measure that, exactly what that means, how does this unemployment factor in, are just exciting things for people like us to track. So very good. Let's see, I'd like to talk today to clients and prospects out there about a specific strategy or opportunity that we're at the end of the year. It's November, even though it doesn't quite look like it. It's gorgeous. But Roth conversions. Let's talk a little bit about Roth conversions.
Sure.
What's y'all's take?
So, it's important this time of year to make sure you understand how the tax code actually works. When we talk about tax brackets, we're talking about taxable income. We're not talking about gross income. So whatever your wages are or whatever your earnings are, however they come to you, you've got to take into the account that, if you're putting a pre-tax retirement contribution away, 401k contribution, that's going to lower your gross income, right? You're going to come down to a number. Even if you make an HSA contribution, that's going to bring your adjusted gross down, okay? Gross income steps down to adjusted gross. Then you take either the standard deduction or itemized deductions. Well, these days, because of the fact that back in 2018, 2019, Uncle Sam changed the standard deduction for married filing jointly from around $12,000 to now it's what, $25,900, I think, is that right?
Exactly.
Okay. That's a big jump. And they also limited state and local tax deductions in the process and capped them at $10,000. So if your house property taxes and your state income tax and your 2 automobile taxes, those are probably going to hit 10 grand pretty quick. And that's the cap. Yep. So you've got another $15,900 to clear in order to be writing things off.
Right.
Okay. So you're probably going to have, 95% plus of our clients are in a standard deduction. Okay. So if you make $100,000, for example, and you fund your 401k, let's just say you fund it. Let's say you put in the $20,000, okay, for 2022.
Down to 80.
Now you're at 80.
Yeah.
Okay. And then you take the standard deduction on top of that. You're now down to $54,000 effectively. Okay. Well, the 12% taxable income bracket, that marginal bracket goes all the way to 83.5. Okay. So the difference between that 54,000 and 83,500, you have the ability to go in and convert your traditional IRA or even your traditional 401k dollars, if your employer will let you, and move them, transition them into Roth dollars, which means pay tax now on that money. But again, if you're in the 12% income tax bracket, that's low.
Historically, yes.
Historically, that's very low.
Yes.
So you look at the opportunity to take advantage all the way up to 83.5, and you pay that 12% on those dollars in that Roth conversion. Ultimately, to us, that makes a ton of sense.
Certainly. And then the beauty of the Roth IRA as opposed to the traditional is now those gains from here on out, 20 years, 30 years, 50 years, completely tax-free. What do you think the risk might be that legislation would undo the value of a Roth IRA tax-free gains?
I don't think there's really any risk of that.
I don't either.
Personally. Once in a while you hear some of those some of those theories, hey, they're going to come and take your 401k, or hey, they're going to tax you more or try to gain,
I'm trying to debunk that because I get that a lot as to whether or not that's going to happen. But we still function in annuities and life insurance under TAMRA 1987. We still have pre-87 rules, which tells me that, whatever we went under before gets honored, or we're no longer doing contract law. So definitely want to make sure that people don't see that as, well, they'll get the 12% now and then maybe try to tax it later. It sounds scary. I just don't think it's a legitimate concern. So
I don't think it is either. And you got to keep in mind, if you're so in a Roth, you're paying Uncle Sam now.
Yeah.
Right. Like Uncle Sam wants to get paid now.
They need it.
Especially when they've got 4% yields. Keep in mind that deficit. They're paying on that money. So ultimately, it just makes sense that they would not mess with the Roth conversion because they get more tax revenue now.
Right. And I think that they'll look for other avenues for starting to make up for this additional yield that they're paying out from the $31 trillion in debt, state taxes, higher future marginal tax brackets. In fact, that's the reason for the Roth conversion is that would be considered low-hanging fruit in my book. If I'm,
that's a good point. And let me share that I'm not generally a big believer. I mean, sometimes folks in our position make it kind of a black and white argument. Well, do you think tax rates are going to be higher later, or do you think they're going to stay where they are? And I mean, of course, the answer is always, oh, they're going to be higher later. Well, that hasn't really held true.
That's true.
For like 4 decades, that hasn't held true. So I don't think anyone in our position can say, hey, listen, tax rates are definitely going to be higher later. But you bring about a very interesting point. If, in fact, the deficit is so high, and if, in fact, our government is looking for tax revenues, well, then they're looking for revenues. And so it's not to imply that rates will be higher later, but if you have a higher rate or cost on money on that U.S. Treasury debt that they've got to pay, the yield to investors on, ultimately, yeah, I mean, they may look for more. And if they do, well, increasing the tax brackets, could that be it? It's certainly possible.
Definitely.
But that would be a reason, not just because, well, like scary, do you think they're going to be higher later? I think that's a scare tactic.
I agree.
I think the notion of cost, though, is a different thing that could come into play in the future. Be interesting to see.
Great point. And we're at the end of the year, as I mentioned before. So this is a great time to look at clients' total taxable income for the year as far as what they're bringing in. Social Security is not fully countable as income, thank goodness. Some of it's 0%, some of it's 50, and then sliding scale to 85. IRA distributions, that's where we're looking for the opportunity for conversions. Any part-time work, pensions, that's really why I wait in my practice to talk to clients in November, December to start positioning for that conversion. However, in a bear market, right? We've experienced 30% down in the NASDAQ this year. That is a tremendous opportunity to go ahead and lock in some of that low income tax bracket / rate in this example, and take advantage of a recovery. So this seems like a double no-brainer time frame to be looking at conversions.
Yeah, I would agree with you. I think if you're able, of course, none of us knows if asset values are going down further or not in 2023. But I mean, if you've got the ability to convert assets in an income year where you're in the 12% bracket, for example, or even in the 22 or 24, the tax bracket takes a jump from 12 to 22, and then it's 24, and then it jumps again to 32. That's an 8% jump. I mean, there's some reason, certainly above the 12% taxable income bracket, to look at Roth conversions. But when the market's off 20, 30%, yes, it's a decent time to be considering those conversions. And you got to keep in mind that you have to do that before December 31st.
Perfect. Very good. Well, I think that covers conversions. I'm going to give you a challenge question here.
Sure.
What do you think about real estate?
So we got asked a lot last year, was real estate in a bubble? And my answer on a national level was no, not really, because in the decade of 2010 to 2019, there weren't as many homes being built. And that's mostly because of the Great Recession. Banks didn't want to lend. Builders were kind of burned, or they didn't have the balance sheets to be building as many houses. So they built 1/3 fewer homes across the country. So that was a supply issue, right? Now we have a very interesting dynamic where, of course, costs are higher. And I think the question turns more geographically at that point. There's still a lot of vengeance going on from COVID, vengeance travel, vengeance leisure, vengeance experiences, right? And so a lot of people are still spending money elsewhere. I think there's going to be a lot of vengeance moving that probably continues as well, both because people want to live in friendlier areas from a tax policy standpoint, maybe from a health policy standpoint, maybe from a natural resources standpoint. I think that's an interesting trend, in the Southeast over the next 20 years. We probably don't think a lot about it, right, because water hasn't really been as much of an issue in the Southeast. There are areas of the country that are pretty dry and running out of water. So
Lake Mead, right? They
found
all sorts of stuff at the bottom of Lake Mead that's been basically draining, right?
Yes.
That's a great point. I was thinking geographically in terms of the influx of jobs into the upstate here of South Carolina and what we're putting together and just the overall draw that you've already hit from other states. But natural resources, that's an interesting part of it, as well as not having to do the transportation. We've got ESG and all these regulations over costs of fuel and what kind of trucks can be on the road and so forth. So the more local your resources now, there's almost a double benefit in terms of saving you taxation and regulation costs as well. That's a great point. I hadn't considered that.
There'll be some interesting things that happen over the next 10 to 20 years in terms of migration around the country. There's a great website. United Van Lines has an annual movers survey, and it's not, an economic development board trying to pitch you on coming to a particular state. It's a van lines company telling you where people are moving from and where people are moving to. There's some really interesting stats, and they do it by year. You can choose the year, 15, 16, all the way to now. It's pretty cool.
Very cool.
Check it out.
We'll try to put that link up here on the video.
Absolutely.
Well, thanks for stopping by, Chris. This has been a great conversation, one I was looking forward to for a while, but
me too.
Think we got hit it out of the ballpark, didn't we? Good deal. Well, thanks for coming by. No Nonsense Investor. What we're trying to do here is just give you real world things that matter in our local area, our local economy. We're not into the whole sales pitch thing. We want to talk expert issues with experts that we can relate with in the local area. So thanks for coming by, and we'll see you next time.